Hello everyone, my name is Mark Newman. I get a lot of questions from people who are either going into business or buying an existing business about which business structure is best for them. So accordingly, I've prepared this series to help give you an understanding of the main types of business structures and their advantages and disadvantages. In the previous video, I discussed operating as a sole trader. This video, I'm talking about operating as a company, and in the next two, I'll talk about operating as a trust and then finally as a partnership. I just want to remind everyone, always seek independent advice as to which structure is best for you. Everyone's personal and business circumstances are different, so what we want to do is make sure we've got the most appropriate structure for you, both now and ongoing, considering your needs. So what is a company? Very simply, a company is a separate legal entity that is established or have its own ABN, tax on number and bank account and operate within its own right. It has directors who tell the company what to do and shareholders who own the company. So what are some of the advantages and why do people set up companies? The first one I want to talk about is the separation of assets. And what do I mean by that? There are simply two types of assets, those that involve risk. That is a business. So for example, if you're operating a business and something goes wrong, the business can be sued and all the business assets can be taken. In addition, any assets that are connected to the entity, so for example, if you're a sole trader, any personal assets can be held liable to meet the business debts. And then we have safe assets. Those, for example, are a house. So what we want to do in this case is put a wall up. That is, if something was to happen within the business and these risky assets are sued, that our personal assets, for example, our house, is safe. And a company does that because it's a limited liability, that is, a separate entity. Now, is it perfect? No. For example, if you sign personal guarantees, that can get access to your safe assets. Also, if you act negligently or trade insolvent, there are ways that your personal assets can be held liable. But providing you do everything right and act diligently, it is a very good manner of protecting your personal assets. The next one I want to talk about is taxation rates. Company taxation rates will be dropping to 25%, whereas your personal top taxation rate can be 47%. Hence, it's a significant taxation saving. Now, whilst that looks great on paper, there are rules that the ATO have put in place that prohibit you taking excess of the 25%, but using the money personally. So therefore, if you take the money without the company, you have to pay the top-up tax rate to your personal rate. And if we just borrow it, as some people try and do, the ATO considers that a Division 7A loan, and that's something that has more adverse taxation consequences. So if we do take the money out of the company, we have to pay top-up tax. Now, if your company fluctuates in its profitability, i.e. one year have a super profit, the next year low, that may be a great way of capping your taxation rates and paying it out in dividends, for example, when your income's lower in future years. And the final advantage I'm going to go through today is when we want to introduce, for example, family members, we can simply issue or transfer shares to them. Yes, there may be taxation consequences in doing so, but it's a way of introducing family members into the business very simply, very easily, and the business operations, ABN number, etc. stay the same. Now, are there disadvantages? Yes, there are. Companies cost money to establish and also have ongoing fees. With ASIC, in addition to that, they have separate financials and taxation that we have to consider. So there are additional compliance costs, and then depending on what we're operating, so for example, if you're a builder, the company will also need a builder's license, again increasing the compliance costs that are involved in that. Is it perfect? No, the directors can actually be held liable for the company's debts and obligations. So the directors firstly have to understand what they're doing as a director and also act diligently. So it's not a foolproof method of protecting the directors. And there also can be significantly complex taxation implications. So for example, if a company buys a motor vehicle that's available for private use, we then have to consider fringe benefit tax that's available. So that's a brief summary of the way companies operate, also the advantages and the disadvantages. Again, if you have any questions about what structure is appropriate for you, please do not hesitate to reach out and ask. Thanks for listening. Mark Newman.